after the session is over. So I assure you two things. One, you will be a very informed decision maker in your day-to-day life. And secondly, after these 3 days session, you will be a rational thinker when it comes to personal financial decision. So in your family, being a husband or wife, you will be carry these tools and techniques hand to hand throughout your life, and it will be required for a good decision maker when it comes to the personal financial decision. So don't take this is a finance class or this is not your cup of tea. This is for your day-to-day decision making. That's why the topic is finance for non-finance. Miss, I'm just thinking that I will start everything from the scratch and very basic things, very basic calculations, which you will be required throughout your life. Now, first we will discuss the plan, what we are going to cover in the next 3 days, so that you get interested and attracted also. Number one, in the today we will discuss, we will have a better understanding of personal financial decisions through various tools. I will use different tools, different calculation methods, different Excel sheets, which I will give you, and it will be a hands-on experience for you. You need not to worry about if you don't know any formula, anything. You need not to know, in fact. You will get everything hands-on. Second day, we will go for the understanding innovative investment products over conventional investment products. In today's world, when it comes to the investment, we think it is the bank saving account, FD. When we move on, we think about the mutual fund. We think about the shares. But beyond that, there are lots. We think about the RD, post office savings, NPS account. These are the products which we know. But do you have heard the name of FMP, fixed maturity plans? Have you heard of exchange traded fund on Nifty? Have you heard of gold? These are the very secured and very innovative financial products which we will discuss tomorrow. That is on day 2, and you will enjoy the session. Then you will know what are there are lots of innovative investment products which you even don't know for the purpose of investment also. And for the smart investing, these understanding of these products are very much required. On the third day, we will discuss designing of customized retirement planning. This topic is personally close to me because everyone thinks that retirement planning is not their cup of tea. I will first explain through the literature why retirement plan is necessary for you. Why you should have being a private employee, a private sector employee. You must, even if you are a government sector employee, because now there is no social security. Your money is, even for the government employees, your money is put in the NPS account, tier 1, tier 2. So why in nowadays, when there is a risk of life and the uncertainty of life, retirement corpus, retirement planning is very much required. And I will make you understand. I will make you customize retirement planning. In fact, I will share the Excel model. You just put your details and the retirement plan will be in your hand. So you can accordingly, you can plan your future. Okay, what amount of retirement corpus is required for the post-retirement life. So these are the 3 days plan. I hope you have understood. And today we are going to discuss only the very basic things which everyone must know, irrespective of your area of specialization, your area of interest, your area of career or profession. This is for everyone. Now, I think this is clear. Now, these are the personal financial decision through various tools, which we will discuss today. First, we have heard the name financial planning, what financial planning actually mean. Second, we have some financial mathematics, must for everyone, the basic calculator. In the participants, there might be some finance faculty. Please mute participants. You are requested. Please mute your audio. Uh, uh, then it might happen in the participants. Most of there must be some participant who are from the finance background or who are teaching finance, yeah, who are expert of the finance. So this might be very basic for them. But since the this training session is for the finance, for non-finance, so even this they will find it fruitful because how the basic things are calculated. Then our the most dangerous thing in our life is the effect of inflation. We will just understand how inflation affects us. Then we will understand the power of compounding. I call it the seventh magic of the word, power of compounding. And I will not demonstrate it why we call it seventh magic of the wonders of the word. uh, then we will understand there are lots of myth about the risk and return relationship. People think if you will take more risk, you will get more return. You are absolutely wrong. Most of the books it is written that risk is directly proportional to the risk return. That is, more risk is more return. You are absolutely wrong. I will explain it what actually it means. Then I will explain through the calculation how the wealth creation is done, what are the parameters required for the wealth creation. So hope you will enjoy the session. And I again assure you that after the session, you will carry some very fruitful things. The only request is if you listen the speaker, you retain 20%. If you note down something, you retain 40%. If you practice those things, you retain 80%. If you make someone other to understand the things which you have learned, then you become 100%. Your retention power goes 100%. So please keep your laptop handy with you, even if you have joined through the mobile. And only then, because these are the skill development programs and you are actually going to learn some good tools, right? Then I'm starting with the basic thing. We work hard to earn money. हम बहुत मेहनत कर we work very hard to earn money. The question is, do we make our money work hard for us? Means whenever we need money, we are always have liquidity crunch. Means we don't have money. When we need money, money is not there. Though we work hard for our money, but do we make our money work for us? Means whenever we need money, is the money adequate money is available for us? You will find that most of the time your money is not available with you. It is blocked somewhere. Might be it is FD, it is in the property, it is in the something else. So we will learn how to work your money for you, because it is hard earned money. And if it is your money is not working for you, it is not available whenever you need it, please remember the problem is with your personal financial planning. If you understand, if you know the mechanism of personal financial planning, this thing will never happen to you. And now I'm going to discuss who required this session. There is one thing, that is the passive income. One thing, passive income. Is it your job? No, your job is not the passive income. It is simply trading of hours. How many hours you work, you get paid for that. If you stop working, you are not paid for that. But if you have some business and you have appointed some managing director or some director to run it, and it is in the autopilot mode, yes, you are reaping the dividend and you are earning the money. All the business families are doing that. So this is your passive income. You have made a smart investment, and that investment is giving you the interest, dividend. That is again a passive income. You have some property and you have let out that property, and you are earning a monthly rental income. That is again a passive income. So please remember, there are two categories of income. One is the active income. Please remember, your job is not the passive income. It's simply trading of hours. How much hours you work, you are paid for that. It's not a passive. Passive income is like this. Now, what is the wealth? If your passive income exceeds your expenses, your regular expenses, you get the surplus money. And this surplus money is used to create wealth. That is used for the wealth creation. So you must have some passive income. I'm just exploring the things before going directly to the what financial planning is all about. Now, when you get financially free, please remember when your passive income is more than your monthly expenses, household expenses. Suppose your expenses, monthly expenses are 40,000, 30,000, 50,000, and your passive income is exceeding that. Please remember, now you are financially free. So your target should be that. And if you don't have passive income, then of course, this workshop, this training session is for you. Now I'm explaining the whole scenario in the market. I hope you people are understanding these basic things. Before going to the what financial planning is all about, we are just discussing these basic things. Now see this chart. There are two categories of people. One is the poor. We call them poor, though it is a wrong word, not rich, we can say. And the second one is the rich. See what is the difference between these two. Now, the poor people have two categories. One is the employees, that is the, and second is the self-employed or small business owners. Employees, what they do, they work hard for business owners and expect safe, secure job. As an employee, what we do, and self-employed or small business owner, they work hard for money. If you see, these are the source of active income, and financial planning is must for you. If they want peace in life, without financial planning, they can't attain or achieve the financial freedom and the peace of mind. The ultimate objective of life is the peace and happiness, and it is possible when you are you have attained, you have achieved the financial freedom. And what they do, this I have categorized them into the poor class because they work for the security, regular income, growth, and social security. Now think about the rich people. They are the big business owner, have people to work hard for them. They have, see the Bildas, Ambanis, and Tatas, yeah, all the business owners, they have people to work hard for them. That is the big business owner. And second is the investors like Warren Buffett, Jhunjhunwala, Rakesh Jhunjhunwala, and other have money to work hard for them. They work for freedom. They have sources of passive income, and only estate planning is required. Estate planning means they have to just plan of who will be their successor, and what will be the allocation of whatever left with them, between them. That is why estate planning. But if you are under this category, please remember financial planning is must for you. And I hope we, all the participants, come under this category. Uh, that is, so now the question arises, what financial planning is exactly all about? That is, what is financial planning? Financial planning is all about matching the cash flows. That's it. That is cash inflows and cash outflows. And these are the things which I am telling you. These are the required for throughout your life. Just keep a watch on all this. Now, as an individual, what could be your cash inflows? One is your salary or professional income, which you are getting. Your investments, which you have made, might be in shares, might be in mutual fund, might be in bank FD, might be in post office RD, might be in other instruments. Then lump sum receipt means sale of property. You might have sold your property somewhere idle, and compensation received, or you have won some prizes, etc. So these are your the cash inflows as an individual when we call it this category of society. See about the cash outflows for the individuals. There is a monthly recurring income, monthly recurring expenditure, then lump sum expenses required towards financial goals. Then I will tell you how to calculate these financial goals, what amount of a corpus is required to meet these financial goals that require for kids higher education, marriage, construction of house, and retirement planning. So as we being employee, being a salaried person, we are exposed to all these things. That is, we need to maintain cash flow. We require uh, cash money for the monthly recurring expenditures to meet the large lump sum expenses toward the kids' higher education, their marriage, and construction of house, retirement planning, and all that. Now, the entire financial planning is divided into 5 parts. This is what personal financial. So first, understand financial planning is simply a matching of cash inflows to the out. You have to just match your cash inflows with the cash outflow so that your money work hard for you, so that whenever you need, money is available with you. Now, for this financial planning, you need to do planning for these 5 aspects. One is the estate planning. Estate planning means just allocating what your property is so that after you, everything will be equally distributed. There should be no dispute. Second is the investment management, because there are 2 ways to increase the size of money. One is the saving. In this era, when the risk of life, the cost of living is increasing tremendously, there is a very little scope to save the money. So a smart investing decision is the only way to increase the size of money and therefore your purchasing. And second is the tax planning, because when your salary increases, to most of a major portion of your money goes to tax to pay the tax liability. And second, as I told you, in today's era, 2 things are continuously going up. One is the cost of living, and second is the risk of living, risk of living. Because the tendency of nuclear family is going up. There is no joint family system right now. So in nuclear family, what happens? The risk of living is going up. If you are not there, then what will happen to your children, your wife, your dependents? And the cost of living is also good. When there was a joint family, might be the expenditures were shared by everyone. And when it comes to the common expenditure, it get minimizes. But since it is a nuclear family, the cost of living is also going up. So for that, risk and insurance planning is must. So please remember, when it comes to your personal financial planning, these are, and the last one is retirement planning, which we will discuss how to make retirement planning in a very scientific way, a very concrete way. I will, through the Excel sheet, I will show you, and you will prepare your retirement planning for yourself right now. On the third day, you will have the Excel sheet. Accordingly, you work on it and you have a sufficient retirement corpus, because retirement means your income stops and your expenses continues, because after the retirement, there is no income, but your expenses will continue. In fact, it goes on, it goes up. So lastly, the fifth dimension of personal financial planning is the retirement planning. So there are 5 dimensions of personal financial planning. One is the estate planning, investment management, tax planning, risk and insurance planning. And the fifth one is the retirement planning. In this training session, on the third day, we will focus on the retirement planning, how to make a customized retirement planning for yourself. So I think you have understood, as an individual, uh, when it comes to personal financial planning, we are exposed to these 5 categories of planning. Now we are understanding one by one. I have discussed these things, uh, uh, right? What financial planning is all about. Then first we are going to understand what is the effect of these things, because this is our enemy, this is our enemy, and this is our friend. The major issue comes because inflation is continuously going up and it is bound to go up. So this is our enemy. And now we come to this. What will be the effect of inflation? Now understand the inflation. You need not to go into the technicalities, the definition, how inflation is measured, what inflation is all about. Just understanding. This is what inflation is all about. It is the petrol prices. And when you will see the data of the inflation and the petrol price, it has a direct correlation, because 70% crude oil, 80% crude oil is imported. And we are heavily dependent on the imported oils, crude oils. And then refinery goes up. Once the oil prices goes up, either it is petrol prices or diesel prices or natural gas, everything becomes costly. So you just correlate, both are synonyms. I'm not going to what inflation is all about, what is the actual definition of the inflation, how inflation is actually measured, because this is not your cup of tea. You simply understand inflation is the oil prices. When oil prices move up, there will be inflation. When it goes down, there will be uh, 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 prices will be curbed and it will remain stable. And this is directly,
Yeah.
there is a direct correlation. Please. Now see the effect of inflation. See the effect of inflation. Suppose uh, for your lifestyle, you require 30,000 today for your monthly expenses. Suppose this is your monthly expenses. Monthly expenses. Then to maintain the same standard of life, this calculation is based on 8%. I will just share one Excel sheet, and with that we will calculate all these things. You just understand the concept, then I will share the worksheet and you will calculate each and everything. You need not to worry about how to calculate it, how you came with this figure. You need not to worry about. I will just simply share it on your WhatsApp group, and you just download it and you will do all the things. If your current lifestyle cost is 30,000 per month, your monthly expenses is 30,000 today. Please remember, after 10 years, you will require 64,768 rupees to maintain the same lifestyle. And in India, it is the RBI guidelines that 8% inflation is assumed. All the calculation as per RBI guideline is done on the 8%, 7 to 8% inflation. Though the inflation sometimes goes, when it comes to the fruit inflation, food inflation, sometimes it go to beyond 11%. But on an average, it is 8%. The calculation is made at 8%. So if your current, to maintain your current monthly lifestyle, you require 30,000. After 10 years, you will require 64,000 approximately to maintain the same lifestyle, to maintain the same monthly expenses. And after 20 years, you require 1,39,000. See the effect. This is the greatest enemy. Inflation is our greatest. You cannot ignore the inflation. We consider the inflation in our planning, but we always underestimate. For example, if we think that today we need 20,000 for our bread and butter, so after that, during the retirement, if we will get 50,000, that will be sufficient. No, you are wrong. After 30 years, suppose your current age is your 30 years. At that age of 30 years is your current age, suppose, and age of retirement is 60 years. 60 years. Then after 30 years, you will require 3 lakh rupees to maintain the same lifestyle. That is why people after the retirement get in trouble. Most of the people you will see that after retirement, they are in trouble. They are in the liquidity crunch. They are in the problem because they consider the inflation, but it is highly underestimated. Not this calculation is simply on 8%. Means if your current monthly expenditure is 30,000, then after 30 years, means if your current age is 30 years, at the time of retirement that are 60 years, after 30 years, you will require 3 lakh. 10 times you require 3 lakh to maintain the same expenditure. See what the effect of inflation is all about. So inflation is our biggest enemy. So never ignore in your calculation what is the prevailing inflation in the market, in the economy. Now, second, I told you this is our enemy and this is our friend, power of compounding. This is our friend. This is our greatest friend, in fact. I will explain you how this is your friend. Suppose if you save rupees 1,000 a year for 10 years at a bank, which gives you only 8% per year return, how much money you will have at the end of 10 years? If someone, I will just, after this slide, next slide, I will just share one Excel sheet. You simply download it. Then I will explain how it will work, how these calculations will come out, how you will get these figures. You need not to worry about the formula which is being used, or you need not to worry about the calculation. Mathematics is not your cup of tea. I don't expect that you know the mathematics. But this is important for you. The concept is important. Calculation is mechanical, and I will share the sheet. You just do the calculation. Now, at the end of 10 years, what will be? And second, if you keep that money for 20 years, then after 20 years, what will be that money? Say, after 10 years, this will become 14,487. Means if you will save 1,000 per year and your rate of return is 8%, please, those who are from the non-finance, non-commerce, don't get bored. You will be interested. Just see this slide and the next slide. I will share the Excel sheet, and then you will enjoy the things, and you will think that this is your day-to-day life, required in your day-to-day life, not irrespective of your profession or career. Now, suppose you save it for 10 years. 10 years means now you have saved 10,000. So what will be your wealth after the 10 years? It will be with the 8% rate of return. Please remember, as per RBI guidelines, all the calculation is done on calculation is done based on number one, compounding interest, or reducing balance. Same thing. Reducing balance. People who say that this we are offering flat rate or this rate, that rate, they are absolutely wrong, because all the financial calculation need to be done based on compounding interest or reducing balance. So if you are investing, if you are saving rupees 1,000 per year for the 10 years at the rate of 8%, after 10 years, it becomes 14,487. But remember, if you do it for 20 years, what will happen? Can you imagine? Anyone? Okay, I'm just telling you. It will become 45,000. See the magic. Just increase your time from 10 to 20 years. It for 10 years, in the 20 years, you will invest only 20,000. In the 10 years, you invest only 10,000. At the 8% rate of return, it becomes 14,487. But if you will do it for 20 years, it will become 45,760. Three times. This is the power of compounding. This is what we call power of compounding. Just give the time. Power of compounding. And how this magic works. See, this is the formula. After this formula, I'm just giving you one Excel sheet. This is what the formula is all about, wealth creation. Maturity value is equal to savings 1 plus R to the power n. Just take a picture and just understand the formula. You need not to do any calculation. You need not to worry about what this mathematics is all about. Savings. See, there are three variables. This is one variable number 1. This is variable number 2. And this is variable number 3. In this wealth creation, maturity value means wealth. In this wealth creation, there are three variables are involved. One is the savings, second is the return, and third is the time period. Now see, which variable is more powerful out of this? This is saving is your in the linear form. R is again in the linear form. N is in the power mode. This is in the power mode. Power mode. See, this N is the more powerful variable, and N is the time period. Time period. Because in this formula, there are three variables to work for your wealth. One, either you increase your savings or you get more return, that is the R, second variable. And the third is your time period. Time period, the third variable is on the power mode. It is in the power mode. And therefore, it is the strongest variable out of these three variables. So the ultimate saying is start as soon as possible. The sooner you start will make a difference, because this will create the magic of compounding. So, and this is what happened here. This is what happened here. You just gave this for 20 years and this became 45,000 and it was only 14,000 and the investment was just 20,000. Here 10,000, here 20,000, but you get more than the second time. This is what power of compound, and this is because of this formula, because this formula is used for that calculation. So I hope you have understood. And now in your WhatsApp, I'm just sharing in the group I Excel sheet. Please wait for a moment. On your WhatsApp group, I have just shared a Excel sheet. You just download it. As I told you, you need not to worry about the mathematics part. This is not your cup of tea. I don't expect you understand that. For this is what your there are different sheets in this worksheet file, and I have shared that Excel sheet. You just see, this is the second, you come to second sheet, that is the effect of inflation. What you have done, you have saved just 10,000, you just put it here, 8%, and tenure is 10 years. Oh, sorry, because it was in the every year mode. So you need to do another calculation. But you can see what, suppose I have gave you, suppose your current cost of living is 30,000 and at 8%. After 30 years, you will require 3,01,879 rupees. Then I am coming to the magic of compounding. He, sorry, I'm just taking a cup of water.
Sure, sir, sure.
Now see this table. I have just made this sheet. Uh, Once I will explain the sheet, only then you put the data on it, because there are lots of sheets in this workbook. So you need not to worry about. Throughout the session, you will find all these things. Now, suppose your current age is 18 years. 18 years, right? Start ages. Here you have started, Mr. B has started at the age of 25 years. And Mr. C has started his savings at the age of, suppose, 45 years. 45 years. See the difference. Age of retirement is same for them. 60, 60, and 60. Now, age at the time of last investment. Suppose Mr. A has started at the age of 18, and just after 6 years or 7 years, he has stopped all the investment. So after 25 years, he has stopped the investment, right? He invested only for the 7 years. And Mr. B has invested for all the 60, up to 60 years. And Mr. C has invested for the 60 years till the retirement. I'm just coming to, if it comes to 45, I'm making it 45. Right, see. Now, see, the current age of, start age of Mr. A is 18 years, Mr. B is 25 years, Mr. C is 45 years.
Mhm.
The age of retirement for all the people is, of course, same, 60 years, 60 years, 60 years. Mr.
Mhm.
A has stopped his investment at the age of 25, this he has invested only for 7 years. And Mr. B has uh, uh, stopped his investment at the age of 45 years and left the amount. And Mr. C has invested throughout his retirement life. Now,
Mhm.
amount of investment is, suppose, 1 lakh. Please mute if someone is not muted, their audio, someone's audio is working. Then amount of investment is, suppose, 1 lakh. 1 lakh for everyone. 1 lakh for everyone. Means Mr. A has invested, total investment is only 7 lakh. Mr. B has invested 20 lakh and Mr. C has invested 15 lakh. Then see. Expected rate of return is, suppose in the current market condition, you can expect a 10% return. See what happens. Mr. A has invested only for, this is the, that is why I called it eighth wonder of the world. I have called it eighth wonder of the world. See, Mr. A has started his investment at the age of 18 and invested only for 7 years and enjoyed the rest of the life. And at the time of retirement, he got 2 crore 66 lakh 61,000 rupees just through that 7 lakh. And Mr. B, who has started investment, enjoyed early life and and thought, okay, what is live the life to the fullest and what is the purpose of investing today. And he started at a later stage, that is at the age of 25, and only did the investment till the age of 45. And then the same investment, that is 1 lakh, and the total investment of Mr. B is 20 lakh. And at the time of retirement, he got only 57 lakh. And Mr. C, who has started his investment at the age of 45 till the retirement, means 15 years he has invested, and 15 lakh is the total investment. And he got only 31 lakh 77,000. See, that is why I'm saying this is the power of compounding. This is the eighth wonder of the world. And this is how the magic works. So I hope you people are enjoying the session, because this is your lesson of life, how to lead your life, how to make your life comfortable, because financial freedom is the utmost requirement for the peace and happiness throughout your life. Now, I'm coming to the uh, next part, that is the risk and return. Uh, there are lots of myth about the risk and return. I just want to clear it. Even in the finance books, this is wrongly interpreted. And understanding the risk and relationship, I have made a story for it, because I am not going into the technicalities of the time. I will never use any formula, any technical terms, anything else. Just simple things, just so that you can understand. This is the story which I have made for you. See the story. This risk and reward. Reward means return. See this story. Everybody wants. Are you getting this slide? Are you getting this slide?
No,
PPT?
sir.
No, sir.
No, sir.
Okay, okay. Oh, sorry. I'm just sharing it because it's stopping that. Sorry, I have not shared it. Now, now we will understand the relationship between risk and return. Please remember, there are lots of myth about the risk and return. People bluntly say that more risk is more return. More risk, more return. This is absolutely wrong. This is not the case. First, you understand a story which I have made for you, so that you can clearly understand what is the actual relationship between risk and return. And this is what the story goes. I'm not using any technical things and jargons. This is the risk and reward means return. Everybody wants to go to heaven, but nobody wants to die. Hope you people are understanding this story,
Yes, sir.
right? Everybody wants to go to heaven, but nobody wants to die. But in order to go to heaven, one must die. Absolutely clear?
Yes, sir. Yes, sir.
And however, death doesn't ensure an entry into heaven. Clear? It means what? Death doesn't more risk. It means more risk does not necessarily mean more return. It simply means more risk, more risk does not necessarily mean more return. Rather, the equation is more return, more risk. Means if you expect more return, only then you need to take more risk. So it is not the more risk, more return. Rather, it is more return, more risk. Understand it. Suppose you are comfortable with 3 to 4% return. Then why are you taking the risk? Just put your money in the bank saving account. It will give you 3 to 4% return. But if you want 7 to 8% return, you go for FD. Again, the risk is minimum, but lock-in period is there. But if you need a more return like 10 to 12%, then you need to explore mutual fund. If you expect 16 to 17% return, then you need to go for the share market. You invest in the share. If you need more return, then you go to more risky business like mining business and other business. If you want to become a billionaire overnight, then you can indulge in the illegal activity like smuggling and all that. Overnight, they become millionaire, but risk is very high. I mean to say, it is not the more risk, more return. Rather, it is more return, more risk. Now, I hope you have understood. So please first assess your risk tolerance level. Accordingly, you plan your return. But if you will increase your expectation of return, only then you require to take more risk. So don't get confused. So first, and how to assess the risk level. You might think that you are a risk taker. You are wrong. It is the personal trade-off. I have seen many rich people who cannot afford the losses. Once a huge loss is there, they will come. They will go down. And I have seen many poor people. They are able to take more risk. It is the personal characteristics. It is your personality, whether you are conservative in terms of a risk taker or you are risk averse or you are aggressive. So please have a valid risk assessment. So I have a tool how to assess your risk level. If you are you aggressive, means you are a risk taker or you are a conservative. It has nothing to do with about your richness or poorness. So please remember, first make a proper assessment through financial planner. What is your risk appetite level? Accordingly, you plan your return. Because even if, then you expect more return, you need to take more risk. If you are comfortable with low return, then you need not to necessarily indulge into more risk. Because more risk does not necessarily mean more return. I think you have understood. Now, this is the Excel sheet which I have shared with you. And now I'm explaining that Excel sheet. Second, which I would like to share with you, that is the effective rate. This is very much required for your day-to-day calculation. For example, suppose I'm giving you one example. Suppose your annual rate is annual rate is 12%. Then what will be your, suppose your rate per annum is 12%. Can you imagine? Just put 12%. What will be your monthly rate? Monthly effective rate is 0.95%. And if you will get per day return, then it is 0.03%. It's not 1%. That is why I said, as per RBI guideline, you need to follow the compounding rate of return, because as per RBI guide, all the calculation is done based on the compounding interest and the reducing balance. So if your rate of return is 12%, monthly return will come out to the 0.95%, and the per day return will come to the 0.0. So please keep this sheet with you, and whenever you suppose you have a 5% monthly return, then what will be your per annum return? Effective return will be 79.59%. If you are having a one per day 1% return, do you know per day 1% return? Do you know what will be the per annum return? If you have some venture which is giving you per day 1% return, you cannot imagine what will be the per annum return, annual return. It is 3,494% return. This is the power of compounding. So how to calculate the effective rate is very much important for your day-to-day life. And the formula is very simple. The formula is very simple. You just do, I'm just explaining the formula for your awareness. Otherwise, you keep this Excel sheet because I have shared this sheet with you. And you just keep this Excel sheet and you will calculate each and everything. Suppose you want per annum 100% return, then what monthly return you are expecting? 100% return means you want to double your money. 100% return means you want to double your money. Then what monthly return you want, you have to earn? It is 5.95%. And per day you require to earn 0.19%. If you are earning per day 0.19% return, in a year, your money will become double. It will be 100% return. These are the calculations. These are the effective return, which normally we are not able to calculate. So I have shared this Excel sheet. Just use this Excel sheet. You will calculate each and every. What is the effective rate? And any rate, if you want to calculate, you just put it. I'm just sharing the formula because those who are from the finance background will know this is very simple formula which is used in this background. And see, this is the formula. Suppose per annum rate is given to you. This is R%. Then per month, what is the frequency? It is the 12. Then what you have to do? 1 plus R to the power 1 by 12 minus 1 whole multiplied by 100. This is per month rate. 1 plus R to the power 1 by 12. This is the frequency. Minus 1 into 100. Now, in your calculator, what you can do? 1 plus R, there is a symbol for cap, then put the bracket, 1 divided by 12, 1 by 12, 1 by 12, and then minus 1 into 100. I'm showing you, just showing you. Now come to, are you getting this slide? Are you getting this slide?
Yes, sir. Yes, sir.
I'm coming to the Excel sheet, sharing the Excel sheet. Now this is the Excel sheet. So this is the formula which I told you. You just put whatever calculation you want, just put equal sign, then have a bracket, 1 plus 0.12, 12% return, right, per annum. Then you put a cap symbol. This is the cap symbol, cap. I think it is visible to you all.
Yes, sir. It is visible.
It is visible to all. And then
Yes, sir.
have a bracket, 1 divided by 12. This is what formula is all about. 1 plus R, that is 0.12. Then use a cap symbol. This is also in your normal calculator. The cap symbol is in your normal calculator. This is the symbol for the power. This is the symbol for the power symbol. Or in your normal calculator, x to the power y is there. You can use this also. So 1 plus R to the power 1 by 12. And then you put a bracket, Since financial planners use this calculation very frequently, uh, then -1 and into 100 and C. Uh, uh, because there is one more bracket. It is 0.9488%. I think you have understood the formula. This is the formula. In the formula bar, you see 1 plus R to the power 1 by 12. See here. See here. 1 plus R to the power 1 by 12 minus 1 into 100. For those who don't want to go into the mathematics,
मीटिंग में हूँ मैं
and
बार कॉल कर रहा है
please mute yourself. And who don't want to go into the mathematics, who don't want to understand the formula, just I have shared this worksheet. Put the value and it will calculate for you. So 1 plus R to the power 1 by 12 minus 1 into 100. So yes, time is over.
May I ask one question?
Yes, sure.
Actually, now you are saying that it is a 12% rate of a rate of interest. Is the nominal rate of interest is 12%.
Right.
And the effective rate of interest is 9.48 or 0.94.
Yes.
So it is, you mean to say it is per month?
It is per month. It is not 1%. People normally say 1%. No, it is 0.94%. And you can solve it. You can solve it. Suppose your per month return is suppose 1%, right? Then what will be the annual return? It is 12.68%.
Yeah, that is counting.
If you are getting 1% per month return, please remember your annual return will be not 12%. It will be the effective rate is 12.68%. And similarly, if bank nowadays, as per RBI guideline, bank is offering per day return per day in your saving account, they are crediting. So even if the bank offers 3%, if the frequency of credit is per day, the effective rate is very high. Earlier, bank were crediting your return interest on annual basis. That was very less. So please remember, frequency plays a lot of role. Suppose bank says, I am giving you 12% per annum interest, but I will credit the interest on monthly basis. Monthly basis. And it will be 1%. On monthly basis, what is the rate? 1%. And effectively, you will get 12.68%. This is what the measure, right? And similarly, that's why I'm saying to get a 12% return, you have to invest only the monthly return required is if someone is saying, I will give you 12% return, and monthly he is crediting 0.95% return in your account, annually it will come to effectively 12%. And you can't say. So frequency is very much important when it comes to financial calculation. That is why I have shared this Excel worksheet with you. So I hope you people have understood what these are very useful tools and very much important things, and this will help you in your day-to-day decision makings. And then the last one, which is very useful for you, and this is in the Excel sheet. I think Excel sheet is now open to you. Excel sheet is open to you. I have shared one bonus sheet for you, that is the EMI calculation. EMI calculation, and you just put in your loan amount, because all of salaried people have taken one or another loan. Either you are exposed to auto loan, home loan, personal loan, credit card loan. Please remember, whatever loan you have taken, all the calculation mechanism is all the SEBI guidelines. If auto loan company, finance company says this is the flat rate, this is that rate, they are absolutely wrong. When it comes to calculation, the mechanism is same as per RBI guideline. And they just to attract the customer, they do the false promises that this is the flat rate, this is the simple rate. There is no flat rate, there is no simple rate. All the calculation is based on. So suppose you have taken any kind of loan, just put the value here. Suppose you have taken 2 lakh 2,50,000 loan. Just put it here. And for 3 years, for 5 years, suppose, and it is at the rate of 9%, 9%, it will calculate you what is your monthly installment. 9%. This will be your monthly installment. So using this Excel sheet, you can calculate your loan amount, your monthly installment, and every month you will find it. Every month, what is your EMI? EMI is fixed. That is the monthly installment, and in that monthly installment, at initial stage, at initial time period, you will find majority of the your monthly installment is 1,884 rupees, out of which you are paying 1,875 rupees as a interest, and only 9 rupees is against the principal repayment. Means at initial time period, you are simply the whole EMI, the whole installment is goes to the interest payment obligation. This is how it works. That is why it is said that don't go for the depreciable asset, always go for the appreciable asset. Only then you take the loan. Don't take the loan for the depreciable asset as much as possible. Avoid the loan for the depreciable asset. Take loan like home loan, and avoid the auto loan on the EMI based. This is the reason, because entire and at a very later stage you will find that that will come. So I think this is clear. And today's session.
Excuse me, sir.
Yes. Yes.
Sir, in the tenure you have taken 59 years, or this is 59 months?
I have taken tenure. Sorry, 59.
Sir, it
years.
was 5 years. It should be 5 years.
It should be. Sorry. I am sorry. I'm sorry. Extremely sorry.
Okay,
वो
sir.
59 हो गया था, तभी वो दिख रहा था. It was looking at yes, sorry for that. It is 5 years. You just put the data and you will get all the details.
Okay.
What is your,
can we put the tenure in number of months?
Yes, why not? You just suppose tenure is how much?
Am I audible?
You just put equal sign.
Singh sir,
You just put equal sign.
YP Singh sir,
Yes.
I think interest payment is also not changed. It is
Yes.
also it is showing the same 1875.
एक मिनट. See, here in this formula, I have used divided by 12, means the rate is divided by 12 and the duration is multiplied by 12. So whatever time period you want to take, you need to take. Suppose in the month, you are saying that in the month, how many months? Suppose 46 months is remaining. So just what you can do, put the equal sign, 46 divided by 12. That's it. The system will do for it. And suppose the rate is you are saying the 9.87%, then divide by 12, and it is the per annum rate. So keep it as it is. Is it clear?
Yes, sir.
Is it clear? And if you want to take it for the 2 decimal, just right click, go to format cell. I'm just making the changes, and go to numeric and put it for the 2 decimal. Put it for the 2 decimal. So it will show in the decimal also. So, format cell, and it is in the percentage and 2 decimal. Then it will come to 9.87%. So whatever tenure is there, if it is in the month, divide by 12 and then put that year. The calculation, in calculation, it will automatically multiply with the 12. And the rate is always given to you in the per annum term. It is not given in the per month term. So in the loan data sheet, your rate is always expressed in per annum term. And it will be in the decimal also. Suppose your current rate is 9.87%, to just put that current rate. If your tenure is given in the month, 56 months is remaining, just divide by 12 and put that in the tenure. since in the EMI calculation, we have always already multiplied with the 12, the tenure, and the rate is divided by 12. That is why this EMI calculator is followed. Clear?
Thank you, sir. Yes, it is clear, sir.
Right. So now we are just recalling what we have done so far, and then we will go to the recap so that we can prepare ourselves for the tomorrow's session, which is going to be a very interesting session, and that is the innovative investment products. And we have learned so far uh, 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 what personal finance is all about. And yes, we are under this category, so financial planning is must for us. And it is always about the cash flow, matching of cash flow to the cash inflow. Then the question is how to calculate the corpus. Calculation of corpus is very much easy. I'm just explaining how will you calculate the financial, what corpus is required for your higher education, marriage, or construction of house. And then I said these are the 5 aspects of the personal financial decision. Then we have discussed how inflation is our greatest enemy in this world, and just keep a watch on the inflation, and always consider that we are highly underestimated in our calculation. So give a fair calculation to the inflation, because otherwise you will be in trouble. And then understand the power of compounding. And this power of compounding is magic, because n is in the power mode in all the 3 variables. The saving is limited. R if you are a conservative, you cannot take more risk, so you cannot expect more return also. The only thing left with you is n, and the greatest thing about n is it is in the power mode. Power mode is the most powerful variable, and this is the power. This is the reason for power of compounding. Then we have discussed what the risk and return relationship is all about. It is not the more risk, more return. Rather, it is more return, more risk. Means if you expect more return, only then you can expect more. You need to take more risk accordingly. And then we have shared a Excel sheet, and in that Excel sheet we have demonstrated the magic of compounding and the loan EMI calculation. Now I'm coming just again to that Excel worksheet, so that you know how to calculate the corpus. And it is simply that thing. It is simply that here. Suppose you just take any example. Suppose for higher education today, suppose today you want to send your kid for the higher education, and that will require 10 lakh rupees. 10 lakh rupees, right?
Sir, sheet is not visible.
Oh, sorry. Right. And this sheet is useful for your calculation of your corpus also. There is no separate formula for that. Financial corpus. Suppose for children's education, the present cost is 10 lakh rupees, and the rate of inflation is 8%. You have assumed it, or you take it 9%, suppose, at most. And suppose the age of your children is 3 years. At the age of 18, you will send for higher education. Then how many years is left? 15 years. I think you have understood the concept. You will require at that time 36,42,000 corpus. This is how to calculate any finance corpus required for your financial goal. You just have this sheet. Suppose that age of your daughter is 5 years, and if you go for any marriage, suppose it requires 50 lakh at minimum 50 lakh. 50 lakh. And after 20 years, and 9% is the rate of inflation. After 20 years, you are expecting her to get married. You will require 2 crore 80 lakh 22,053 rupees to get corpus for her marriage. So I'm not uh, putting you in the trouble, just opening your eye. How can you calculate the corpus required for different financial goals? It's not any rocket science. It's a simple calculation. You just put the current cost, present cost, and what will be the future cost after that period. So let it be any higher education or marriage or construction of house. Suppose you have just started your career and you are expecting your own house after 10 years of your service, and presently the house is available at under your budget is 1 crore, is 1 crore, means 100 lakh, which you are dreamed of. Right? And you have just started your career, and after 15 years you are expecting that house to be constructed. Then you will require 3 crore 64 lakh as per the normal rate of inflation, that is 9%. Though the property rate is very volatile in the market, sometimes it goes up unexpectedly, and sometimes it remains normal. But I'm taking all the calculation on the normal rate of inflation, prevailing rate of inflation, that is 9%. So suppose you have a dream house of to be in Greater Noida, a posh area, and it is currently available at 1 crore, and you have just started your career, and you are expecting that after 15 years you have your own house. What amount you will require at that time? It will be 3 crore, approximately 64 lakh. So I think this will help you in understanding your basic financial calculation. This is not the finance class. This is not the, this is your lifetime. This will make you an informed decision, a rational decision maker, so that you can do your own small calculation. You need not to worry about the financial expert or financial advisor or someone go to bank and all that. You just do your calculation at your. This is the purpose of this training workshop for 3 days, to make you aware of the basic things which is required for your day-to-day life and your personal decision making. I hope you have enjoyed the session. If any
Absolutely, sir. Absolutely wonderful, sir.
thank you
Now,
so
sir, in
much.
the last 10 minutes, I just want to invite queries
Right.
from the participants. Any doubt in the today's session, you can please feel free to ask to YP Singh, sir. Anyone, if there is any doubt, please feel free to ask.
So,
सर एक्चुअली मेरा एक क्वेश्चन था.
please continue.
Yes, yes, yes.
हाँ सर, एक्चुअली एक एक्स अमाउंट मान लेते हैं 10 लाख.
Right.
सो एक ऐसा समझ लीजिए मेरे पास बैंक की लिमिट है 10 लाख की, जिसका पर एनम 9.5% है समथिंग.
Right.
ठीक है. सो मैं इसे कहाँ इन्वेस्ट करूँ जो मैं ये 15 से 16% पर एनम इसका रिटर्न मिल
Right.
जाए.
Now, see, what is the logic? You might have heard the word that in share market you get 15 to 16% return. Do you know what is the logic behind that? Have you heard this nomenclature? In the long run, in the long run, market is represented through NSE or BSE, right? In the long run, market gives you 16 to 17% return. 16 to 17% return. Do you know what is the logic behind this? You are asking this question because I am a financial planner. So you will automatically explore the product which will give you the return. Have you heard this saying or not? In the long run, market gives you 15 to 16% or
Yes,
16 to 70%.
Yes, yes.
Yes.
We have heard
Now,
that, sir.
now see the magic behind this. How this happens? When BSE was launched, BSE index, that is the Sensex, it was launched in
7980.
7980, right? So it was then put at 100. Now it is 2024. What is the Sensex level? What is the
72,000, sir.
72,000, and now it came down to 71,000 approximately, 70,000 something, because in the last 3 to 4 days, market has lost the market capitalization to approximately more than 1,500 point. So assume it 71,000, right? And how many years it took 100 to take the index of 71,000? How many years? 80 to
44.
44 years. Now, now I'm going, just taking you to the, keep this slide with you. Take the picture and remember the data. In the 44 years, the 100 point became 71,000. Now I'm sharing the Excel sheet, because every calculation I do using the Excel sheet, right? This is the Excel sheet. I'm just sharing. I'm just sharing the Excel sheet. I'm just sharing the Excel sheet. So is it clear to you? Excel sheet is visible to you?
Yes,
Yes,
sir.
sir.
Yes,
Now,
sir. Yes, sir.
now in the function column, there is a function, insert function, go to function, right? And in the function, you just write down the rate. Go, and you will get the rate. And here, your solution is, how much year you have taken? 44 years. And what was the money invested? 100 minus 100. Since it was the investment, so it was 100. Now that money is grown to 44,000. Sorry, 71,000. 71,000. Are you getting what is you are getting this sheet or not? You just to go to finance function. There is a variable known as rate. In the 44-year, NPR is the time period 44, and the present value is minus 100, and then future value means today the index is 71,000 approximately. Just to see here 0.16, and you see it is 16%. That is why we say in the long run, and just put it in the decimal form, and you will see it is between 16 to 17%. That is why we say that same thing you can calculate the return from the Nifty also, that is NSE. 16 in the long run market gives you 16 to 17% return. Now I'm coming to your question. So now if you want to get more return, there are two options. One is the long run of the share market. Since you are not a professional, you don't have time, you don't have required skill, you don't have infrastructure to assess, to analyze the thing. What you can do, the mutual fund. There are few mutual funds which I will give you in tomorrow's session, those innovative products which will comfortably give you 13 to 14% return. 13 to 14% return. This is the answer of your question. Because when you expect more return, you have to take more risk. So directly, I don't suggest you without having a great amount of experience or exposure to stock market, you can go through the equity diversified mutual fund. There are lots of innovative products within that equity diversified mutual fund schemes that will comfortably give you 13 to 14% return. And so this is the answer of your question. I hope this has resolved your query. There is no magic. There is no shortcut. Please remember.
Thank you, sir. Sir, tomorrow I will ask you one question, sir.
Sure, sure.
Sir, today you just scared me by all the calculations that how the inflation, is going to come in the coming up time, how it is going to eat our savings.
Yeah.
So, sir, my one question is how to beat this. So,
Yes,
like you
because
say, 13 to 14%, sir, like in the equity diversified mutual fund scheme SIPs. So, sir, can I take a single conclusion from this statement that
There is a concept of real rate of return. This should be positive. Real rate of return means inflation adjusted return.
okay, sir. Okay.
So I will explain you tomorrow. And once I will do the retirement planning, this will come automatically. What is the real rate? If this is positive, only then you have gradually growing purchasing power. Otherwise, you will lose your capital and you will be in trouble at the time. And I have lots of literature review. I will show why you should worry about the retirement planning. People have a lot of myth. I will just clear it out. So, I think the session is over.
Yes, sir. Yes, sir.
Thank you.
I think there is no query from the participants now.
एक्चुअली एक क्वेश्चन और था मेरा
Yes, ma'am.
हेलो
Yes. I'm
सर लाइक मैं आज अपने 10 लाख अगर इन्वेस्ट करता हूँ जैसे आपने बताया 13% पर
Hmm.
सो आप तो लाइक जो आज वैल्यू है 10 लाख की
Hmm.
तो वो तो इन्फ्लेशन के हिसाब से वैसे भी मतलब बढ़ेगी
हाँ.
सो तो लाइक
Not
मतलब
necessarily. It depends where you are putting that money. If you are putting that money in the saving account, it will give you only 3 to 4%, and the real return is minus, negative. Obviously, it is not going to. Why you expect interest? Why you expect return? Just to cover your inflation. See, in Japan, banks never give you any kind of interest on your deposit because there is no inflation at all. There is a deflation in Japan. In US, the rate of inflation is only 2 to 3%. That's why in US, the rate of interest given against your deposit is merely 4 to 5%, because the purpose behind the giving interest on your deposit is just to cover your inflation, to intact your purchasing power. So in India, the rate of inflation is not only volatile, but high also. That's why all the investors across the world come to India, because they get high rate of return, because here rate of inflation is high. Here rate of inflation is approximately 8% as per RBI calculation. And therefore, if you are not covering this rate of, there is a mechanism to calculate the real rate of return, that is the inflation adjusted return. If it is positive, only then your purchasing power is increasing. Otherwise, your capital is just going down. There is a erosion in your capital also, purchasing powers. Yes, sir. Manoj.
Yeah, sir, actually, I want to know that you talked about this inflation erodes our or eats our entire savings and the planning and all that. So here in this sheet only, you showed that 1 crore will become 3 crore 64 lakhs if we want to get the house after 15 years with the inflation rate is 9%.
Right. Very.
I am suppose here I want to know that how this inflation is of course eating, but the value of the land is also increasing. How that calculation is taken into consideration?
Right. I am here assuming that the value of that is why at beginning I said the property rate is beyond the rate of inflation. It increases unexpectedly. Suppose in the COVID, the property rate has suddenly gone down, and there are lots of property idle just for I'm just using a example that even if the property rate is increasing at the rate of 9%, and in metro cities, when you come to society, the flats, you will see the property rate, the flat rate is not going more than 9 to 10%. It is if it is independent house or a plot, then the price is yes, right now it is going, but it's time to time vary, location to location vary, so we can't define it. So I have just simply taken a calculation. Suppose you have got some data from the literature that it is property rate is increasing by 15%, then of course your figure will change. You will require 8 crore 13 lakh for the same property. This is merely a calculation. And here, it is not the rate of inflation. This is the rate of increase. This is the rate of increase of your property. That is why I have used the title effect of inflation oblique corpus. In corpus, it is the rate of, not the rate of inflation only, it is the rate of increase. If it is, you are taking the example of property, take it as a rate of increase in property.
It means, sir, that if the property rates are increasing at a rate of 15%, the total value of my property will increase to 813 lakhs.
Yes.
Yes, but I want to know, sir, when the inflation is also increasing at 9% and the property rate is increasing 15%.
Everything increases. Whatever increases. Why? Because there is demand. And this is the concept of inflation. What inflation is all about? Inflation is increase in the demand, increase in the prices of goods and services. And it is due to high demand. When supply is less, demand is more. So there is a demand pull inflation, or when cost is increasing, then there is a cost push inflation. So that is inbuilt. It is the property rate is increasing because of the inflation, because of the high demand. So inflation is inbuilt in its increase. When you take 15% means you are already considering that inflation. If there is no inflation, sufficient supply is there. In COVID, you have seen. In COVID, you have seen there are lots of flat vacant, and daily the RWA, the LDA, Noida Authority. Please mute those. And Noida Authority, and even in Delhi, NCR, there are lots of authority. They were selling the property at a bare minimum rate.
Agreed.
So because that there were no demand, there were no purchasing power with the people. So it is because of demand the property rate is increasing. If there is no inflation, how the property rate will increase? Because there is sufficient supply. Yes, sir.
Got it, sir. Thank you.
Thank you.
Very nice session, sir. Very informative session. And calculations are very, very much interesting.
Thank you.
Thank you, sir.
Thank you, sir. I think, sir, we should stop the session, and all participants, please join on time tomorrow on the same link from 7 to 8:30 p.m.
Okay.
Thank you, sir. Thank you so much, sir.
Thank you much.